I'm just going to roll through here and kind of do a little introduction, and then away we go.
Great.
In case anybody watches the video later, just read the risk disclaimer. This is not financial advice, and I'm not a financial advisor, so be careful what you guys do with your money. The analysis techniques that I'm going to show you guys, I use for sort of like a daily type of thing. So it's not really a long-term analysis. I would say it's more of an interweek analysis, and it is really tailored towards the bull market environment. These principles can apply in other situations as well, but they're most effective in this type of volatile market environment. So this is a little bit of a breakdown of what I'll be showing. And this is the foundational stuff that I use every day. So when I open up my computer in the morning and I start to look at the markets, I want to look at daily levels and how they're being broken. So if a daily high or low is broken, essentially that's a move out of the range, or just the periphery of the range was penetrated and it might come back in. But that tells me a lot about what's going on and gives me the directional bias as well as an idea of how far a price might reach trading intraday. The unfinished business thing is where I kind of determine if I'm in a scalping market environment or if I should be looking for a big expansion trade and maybe hold a position to go outside the range. And then order blocks, I'm pretty sure most of you guys are familiar with order blocks, but how I view those is really just an entry and an exit zone. Not all order blocks are created equal. Sometimes you have to let price hit an order block and kind of bounce around a little bit and start to set up structure before your edge really develops. And I'll show you guys how I then use points of interest within those order block zones to get my entries, either when price first comes into the zone, or sometimes you can even use those on low time frames after price has turned and is headed out of there. So those are the foundational things. I do other stuff like time deviations, price deviations, kill zones, pump patterns, and those are quite a bit more advanced. I wouldn't really suggest that these are something that work as a standalone strategy for analyzing things. You really want to have the foundational stuff down pat first, and then this is sort of icing on the cake, if you will. So hope that all makes sense, and if it does, we'll hop right on into it and get started on the first thing. We'll look at the daily level breaks. So I have an indicator that delineates the highs and lows of each day. And this indicator also has the open close on it. I'm not going to go into depth on that very much, but that's how it would look if you also put in the open close. There are some times when open close has some effect to my trading strategy, but not a whole lot. The daily highs and lows are really where my focus is. Can you guys hold on for just a second? I gotta go close this door. All right, I'm back. Can you guys hear me okay? If you just want to let me know that.
Yeah.
Okay, cool. All right, so the reason that these daily highs and lows are so important is in the way that they're broken. And what I want to see to form directional bias is that price does something like this, where it absolutely viciously slams through a level and then starts to stay below. When I see that, that's a good indication of continuation coming because there's a lot of momentum. And so a lot of times that will create a multi-day directional move. So let me turn on these levels here. And just to show the example, like this level here versus this one where it broke this daily high, it came back, it faded back fairly deep into the level, started closing candles underneath the level. So that's an indication that it's not really, it doesn't have that much momentum. It's not really trying to go too deep. So there's likely going to be a pullback that will take some bottom side structure liquidity out before a move higher. And this might not be the best range. Well, we'll look at these guys over here too. But again, you have this dip below and then you pull back and you kind of consolidate back from on the other side of the level from which price came from. So depending on the context, this can also mean like if you are, for example, if you're at the top of a swing, that can be your sign that things may turn around and put in a deeper retracement. And if you're kind of range locked, if it's doing that on both sides, then that's where I tend to just scalp a lot more because I'm not getting the inclination anyway that we're due for a big breakout for another swing. So this level break, it's important how deep price comes back across the level. One of the things that I use to just kind of give me an idea of what that looks like is the fib. I put it right on the level. I want the center of the fib to be right on the level. And then I measure out as far as price came back through the level. And then I just kind of observe how price is behaving around this level. So in this case, it's spending quite a bit more time below the level, and any closes that it had above, they didn't really last very long. It was kind of the top of the swing, so to speak. So when I look for a continuation, I let this form, and then I can, once this has formed, now I can look for order blocks and points of interest on the low time frames to try to snag a continuation move. And I'll get into that when I get to that part. But I want to show what this looks like as well when you have a strong move up as it goes through daily levels. So this was a daily level. These were daily levels a little bit across the dip, so 2 or 3 days past. And when it shoots through them like that, that's a lot of momentum, and things tend to try to stay bullish for a bit after it does something like that. I want to just show this level so you can kind of see. I mean, it's a little different than the other level that I just showed, but again, if we take the fib, and after it had closed a candle through the level, I want to see how far it came over or came back. So that's what it looks like. So as soon as it gains support and starts to move higher off the level, there's even times when there's an opportunity for entries in an area like this, and you'll understand better what I look for once I explain the points of interest. One of the main things that I want to see, though, for confirmation that we are likely to stay above the level is wherever we have formed a temporary swing high from shooting through the level, we get price going higher than that again. We have price make another swing that goes higher than price previously had gone. But also, so we could have had this candle that goes higher, but it could have faded back and closed below these, where this candle closed. So the other criteria is that this candle that makes the new high also has to close higher than what this one closed. It doesn't have to close higher than what price previously was. It just needs to close higher than that previous close. And that's a really strong criteria. So in all of my strategy here, that's something that applies to pretty much anything that I'm looking at. And we can look at a few more of these here too. So this break here wasn't really very strong, and it also didn't consolidate very long once it got through the level, and it kept going up. And I don't have any specific examples here that I can think of off the bat to show you guys, but if price shoots through a level and just keeps going and it does not take time to consolidate right above the level, it typically always fades. It comes back. So after this breakout, we broke this level here. We consolidated a little bit right above the level. And again, here is the criteria that I was talking about, where the confirmation comes in when you get another price swing that goes higher than the first one that came through the level, and also closes candles higher. And I do watch that on the 15-minute chart to qualify that. So here again, shoot through the level, we consolidate. We kind of took off fairly quickly again, but came back to consolidate again. This is a sustainable high momentum move. And the difference here is, like, let's say if there was a level right here, a daily high, and it went through here this aggressively and stayed this high, most of the time these fade and come back. So when a significant level is broken, I always want to see that little pause before moving higher. Otherwise, like I said, things start to become unsustainable. And you can kind of see that right here. I mean, there's no level here, but price would kind of surge a little bit, stop, consolidate, surge a little bit, stop, consolidate, and it just keep doing that, and it was sustaining that move up. But as soon as it started getting a bit parabolic, then eventually it just, got exhausted and came back to where it had last consolidated. So yeah, I use that a lot to just confirm that, hey, we can keep moving up as long as we break levels like this. And it also helps me really gauge the momentum by seeing how price goes from level to level. And what I'm showing you guys here is what I call daily highs and lows levels. And inside a day's range, that's what I call an inside range. So on small time frames, you have levels that occur inside your daily candle range, just like this one. An aggressive breakthrough, and then it trades back up to the level, consolidates, and then finally it pops through again and held above that level. These are a little trickier to play because with this type of level just being a low time frame intraday level, things can change fairly quickly, but it's nice to be aware of them because it helps you kind of analyze what might happen next. So it's the difference between having confirmation that price is still continuing in one direction versus the other. I'm going to wrap that up with respect to the levels. So if you guys have any questions on this, let me know. We good?
Yep, I think we're good with that one. Let's we can move on to unfinished business.
Okay, unfinished business has to do with a good order block or not. So when price turns, there's times when it turns and comes fairly aggressively out of wherever it was heading. So like this swing when it was coming down, you've got the two red candles, and then as price went down, it got bought up really hard and fast, and it shot out of there. It was like it was chased out of there. And so you have this, what could be an order block candle if it was red. So what I like to see is that the outermost candle matches the color of the swing. So in this case, again, there's unfinished business here because this outermost one should have been green. The ones with the green arrows are finished business. The ones with the red arrows are unfinished business. So like this guy here, this was a swing higher, and it closed with the outermost candle still being green. So what I see a lot of times with this is that there's an objective for price when it is going in one direction or the other. And when it gets there, and this could be the market makers being able to reach their quota at that level. There's a lot of complexities that go into it, and some of it might be speculation on my part as far as what happens there. But by keeping an eye on this, you'll get an idea for whether price is done at that level or not. And you really want it to be done so it's turned around and you can actually take a swing out of the zone and onwards. But let me go out to the 1 hour, and I want to show you what that looks like on the 1 hour. Okay, so here we have one that's unfinished business. Here we have another one.
Really quickly, just so we can reiterate, when you say unfinished business, you're talking about a swing low where the actual candle that forms the swing low is green. You really want it to be red to confirm that it is a finished, the moves.
That price was finished going in that direction, correct. Because what that means to me is that the seller, the market maker, whoever really wanted price to go down there, accomplished their objective. If they were able to close that candle red, they likely had enough time to accomplish whatever their objective was for driving price down there in the first place, during, say, accumulation or whatever it may be. So this was just a very good indication that price kept getting chased, kept getting bought up too fast. They couldn't hold price there. So they had to continue driving it down until they were able to hold it down there long enough to be able to finish their orders, whatever their objective is. And that was accomplished over here. And you can see how price spent a lot more time down here this time than it did previously on these others. These others were just very fast reaching candles that shot back really quickly. There's another example of that up here. And a lot of times that happen. I see that happen too when prices all of a sudden gets very volatile. So we have that right here, and right here. these should all been red candles if business was to be finished. And so we had this drop that came down here, took all that out, and now we're working our way back up. So this definitely helps me form a bias when I see this. Like this to me is good enough to be finished business. So is this. And price spent a bunch of time here as well. So whatever objectives that needed to be accomplished up here were able to be accomplished. And with these hanging out down here, it just seems to be a high probability scenario from what I've seen for price to then return and come back and have price delivered again in these levels. So. Let's see, I think that, yeah, so anyway, that also helps me form a bias for whether I want to have a swing trade or just another scalp. So if this wasn't such an insanely bullish market, in the scenario, I would have likely gotten a position that I could hold for 2-3 days and just kind of see how the week plays out. And if it looks like we could really reverse here, and this could be the high of the week, then I might have held that out through the week. Otherwise, if I think we're just going to be locked in this range, then I'll pick objectives like this to exit. So if I entered up here, I would look for an order block with a really strong move to exit, or I would look to exit after, say, liquidity is breached on the bottom side here or below here. That all makes sense to you guys?
Yeah, I think that's pretty clear.
Okay, let's see. So order blocks, like I said, I view them as zones. And
oh, sorry, one second, Wolf. Someone's asking if the principle of unfinished business works on all time frames.
it does, but I see it being more accurate on the hourly level probably than most others. So, but I definitely consider it on the hourly, the 4 hour, and some on the 15. When I marked those up earlier, I didn't even realize that was on the 15-minute chart. I was just putting lipstick on this thing and got to marking. But yeah, mostly, like I said, I use them on the hourly, but it does apply to the 4 hour as well. If we go back and look, so here you have your 4 hour. Now this is questionable, right, as to whether this would have taken care of business or not. But again, when you have volatility and prices really quickly in and out, a lot of times those price objectives do not get accomplished. And so we shot out of here with this green candle having been the lowest in the swing after this guy. And ultimately we ended up trading back down in here. Again, here you have your green candle being the lowest price in the swing, and we came down the drop after, also right here. Versus, say, over here, the red candle is the one that goes the deepest. And this doesn't always happen, and you have to also take it into context. So, like over here, you could essentially say that this guy here is one of those, but I wouldn't consider that factor just because price has spent so much time here. If there were objectives to be accomplished, then most likely they would. So I would ignore this guy. So yeah, definitely want to take it into context as to how much time price has spent or taken at the level. Okay, order blocks, like I said, I view those as entry and exit zones. Points of interest, you typically are going to find those in those order block zones, but you can also find them in structure that is trending. So we'll go ahead and dive into that one. Let's see, I'm going to go to the 15. So we had that H1 order block up here, and it did get hit, but it was just a real quick reach for it and shot right back out. They're really hard to get, because if you tried to go to equilibrium with the block, you would have missed it. If you placed an order on this side of the block, there's a lot of range for it to still go. So maybe you layer through there or whatever. What I typically do is, if I'm interested in taking a trade off of a block that has a lot of range, I would just put up a very small order size, and then see if it looks like it's going to roll over, and if it does, and kind of starts making these lower highs, that's where I would scale in some additional position size. So for example, we hit the zone, so I'm going to be on the lookout for an entry, but I need to have market structure continue to set up here to start to give me an edge. And what I look for points of interest is the outermost candle, whether it's the wick or body, whatever is like lowest on the inside of the swing. So like on the inside of this swing, this is it'd be the highest on a swing high. So this would be the highest point on this swing. This guy here would be the highest point. But because we kind of had these two little swings here, I would also look at that. And then we just had a lot of these little nubbies in here. So this, all of these become points of interest for me. So now my point of interest zone, if you will, is this. And that gets pretty precise. So also, to get very, very specific on points of interest, I don't view candle bodies themselves as a point of interest, because most of the time price is after the wick, and you don't always know if it's the outside wick or the inside wick, but price wants that wick. For a good example here. All right, so I'm going to mark this off. This is the lowest point in this swing low. I'm also going to mark this off because this is the lowest point in. It's kind of like a double dip little swing here. So I'm grabbing the two lowest ones. So depending on how much momentum there is, so to speak, to one side or the other, price tends to come back, and it tends to hit the inside wicks if it's got good momentum to keep going. So if it's really bullish, it might not even quite hit the inside wicks. So if this is your lowest candle right here, if price traded up and then put the retrace in, it might just barely even hit this. So that's another momentum gauge, if you will. But if it's, say, in a consolidation range, there are times when they want the outside wick. So then I would also mark just below the body. So the real interest in whatever your candle is that holds your point of interest is in both wicks. So price is very, very bullish coming off this block. chances are it would come and it would just hit the top of this wick and maybe get to the body. If it's a little more sideways, it might shoot for the wick just through the body. If things are really like on the verge of maybe turning and it's indecisive or whatever, they tend to even come all the way out towards the middle to end of the outside wick. There's your hit. So in this case, what this was shooting for was the wick right below the body. It didn't quite make it there, but it's close enough. So when I place orders in spots like this, I do account for that. I usually give a small margin for error. So if I want to have a low side wick entry, I actually put it up the body just slightly for the order. And likewise, if I think that it's so bullish that it might not even pull down into the wick, I would put the order just a little bit above the wick. All right, so another thing that I like to look at is where was the battle fought, so to speak. This was a very aggressive move down, and then it turned around. So I'm looking for maybe like a volume spike. I'm looking where the most energy was. So in any order block, I want to identify if there was any high energy in it. I definitely want to identify the candles that contain that energy. And those are most likely then to be hit on the inside wick. Those tend to be very, very responsive. And then I would also mark this guy off just because if the sellers were really pushing hard here and then the buyers came back, the sellers took one more shot at it here, and obviously, got overpowered, if you will, and the price goes on up and away. So let's just come over here and see how things responded when they came down here. So this guy right here, the start, if you would have looked at the hourly, since we're on the 15-minute, if you would have looked at the hourly, this hourly candle that would be the very top of this hourly candle, and that's the candle that held the most energy. So when price started making its way down here, it got its first really nice bounce off of there, and then of course continued to grind down, and in this case, the furthest that it really came was the top side wick of the lowest candle, the candle that made the outside lowest price. Let me get some of this stuff off the screen. Any questions on points of interest so far? I'm going to show you guys some more, but if you have questions, fire away and I'll include that.
I got a quick question. So when you're doing this, you're on a 15-minute chart. Do you then continue to go lower and look for confirmation on a 1 minute or a 5 minute, or do you tend to stick with that 15-minute to get your entry, your stop loss, and maybe some take profit points?
Good question. I'll actually show you what my setup looks like, and I do go on the 5 minute. The 15-minute is kind of like your sweet spot. The hourly is what really clues you into the area. The 15 kind of is your sweet spot for narrowing things down. But the 5 can be helpful. So the way I set my chart up, I have the 1 hour. Let's go over here. Then the 15 and the 5. I will say right now, points of interest, the thing that I'm explaining to you guys right now is absolutely the bread and butter of me being able to get into good trades and be very, very precise. All right, so this was like a couple weeks ago when we came down right before all of this huge up action. And I missed getting in anywhere down here. Price had made this turn and started its initial consolidation right here. Before I can't remember if it happened early in the morning or what, but when I got to the charts, this was essentially what I was left to start working with. Well, the first thing I want to look at is the hourly and just kind of see, okay, does it look like business is finished? Yes. Where's the energy? And it's very obvious that the energy is in this candle. To me, I'll turn on the volume just to see, but yes, there it is. That's the biggest volume spike. And it doesn't necessarily have to be, say, the biggest volume spike, although usually the high energy candle does contain that. But the battle was fought on this thing right here. So the first thing I want to delineate is where the very top of that candle is. And a lot of times when it's done, you're not going to get an opportunity to enter on the lowest, the body of the order block that's at the lowest point of the swing. They're out of there, and they're not going to let price come back in there. So the point that they really protect is at the edge of wherever the battle took place. And as you can see, I mean, it hit it perfectly. So then what I do to start adding on position size is I let a little bit of structure develop. And this being the 15-minute, we've got our swing high here. So before I can, these things here, like the lowest candle, or the lowest point on the inside of the price swing is this nubby right here. So is this guy right here. So I can start, marking things like that off, but until price actually goes higher than this swing high and closes a candle higher than these candles over here closed, I cannot take an entry in here. So I just have to wait for that to play out, and sometimes it doesn't come all the way back. But meanwhile, this is telling me a lot. This is telling me kind of what I can expect from price as it moves out of the area. So on the 1 hour, I also want to mark the lowest in here. I'll do that on the 1 hour and on the 15-minute. And I also like, I also like to mark out the highest candle in the middle of a dip. So if there was a swing low and a little attempt to go higher, but then back down a little bit and then your swing, if there's a point like that in the middle, in between it making another swing high, that's also a point I keep track of, but it's not as significant as the lowest inside point on the 1 hour and the lowest inside points on the 15-minute. So in this case, that is where it came to. It was the 1 hour. It came to the lowest inside point on the 1 hour and then shot off of there. So now I know that this is really bullish because they are barely even touching the wick on my point of interest. They're definitely not going to all the way to the body. Then here is where I actually got some more entries. I again waited for my criteria to fit for this thing for price to go higher and to close higher than these candles. So I start delineating the lowest on the 1 hour, the lowest on the 15. And this qualified as an entry because my criteria was met by this going higher. And as price moved higher, it also came back and, tapped the 1 hour. But not only that, notice how it did it right before it was ready to take off for a pump again. So a lot of times you'll see this happening over and over. So the stage was set, so to speak, down here. This was the 1 hour inside point. It was tapped right before takeoff. And again, same thing happens here. And yeah, that was kind of the extent of that first leg up. But yeah, let me know if you guys have questions with respect to the points of interest.
Well, pretty good. Pretty clear. Ben is asking, what are the typical pattern? What are the typical patterns for point of interest recognition? Ben, I mean, you feel free to unmute yourself. I'm not sure if what we just went through answered that, or if you have a more specific question.
I don't know that I really have. I don't really go by patterns, so to speak. To me, it's simply, well, let's just put it this way. So always the furthest outside point that price went, the candle that contains that information is always a point of interest. And then also the lowest or highest inside point. By inside point, I mean, if you look at the swing, you want to find the lowest point on the inside of the swing. Vice versa, if it's a swing high, you want to look for the highest point on the inside of the swing high. And in this case, this serves as both. Let's say we consider this a swing high. This serves as the highest inside point and also the candle that had price action go the highest in the swing. Versus down here, this candle didn't go as deep as this guy. So really there's two things that I would track on this. But yeah, like if price is truly done and turning around, it's rare that you hit these points more than just, at the very, very edge of wherever this point of interest is. Is there anything else that you would like me to kind of get more specific on?
Not with this. I do have one sort of related question, and this is about leverage.
Uh-huh.
And I'm sure everyone here has noticed that when you share some of your positive trades, you're at like 125x leverage almost every time. Now, are you starting at a lower leverage point and then cranking it up once you're in profit?
No.
Or are you starting?
No, I just use the max leverage of anything, like if I'm on Binance, they offer 125 leverage on Bitcoin, and that's what I use. I use whatever the max leverage is that I can get on something. For me, like what I learned a long time ago is it doesn't matter if I'm using 100x leverage or 10x leverage. I can over leverage no matter what. It's a matter of knowing how much you can put on for position size to only risk X amount of your account.
That's part of it, but then you also have to think of where your liquidation price is. And a lot of the time when you're playing with like even a trade I took today with Ripple, I was playing with 50x leverage and I got liquidated on that trade because the margin of error is so slim.
So I use cross on my wallet. My leverage is never isolated.
I see.
But yeah, I can see where that would be an issue because there would be times when yeah, something would happen and you could get liquidated because of too much drawdown because it's isolated to the position itself. But
Exactly.
no, I use cross, and then I know where my cutoff point is, where I'm going to set a stop, and that's how I calculate my risk that I'm willing to put up, right? So if I know my stop's going to be here, well, how much room is there? How much percentage does that go? And then what am I willing to lose when I throw it at this trade? So if I'm willing to lose $100, I just figure out the formula. If I'm at 100x leverage, how much I can put on this trade in order to stay at the threshold of losing $100 if it goes against me.
Mm-hmm.
So, yeah. Yeah.
We got one more question here. It says, not to get too off subject, but what is cross? Pros and cons.
So cross, that opens up your entire wallet to that trade for margin. So if the trade goes against you, margin will keep being added to the trade until either the trade comes back or it uses all the margin in your wallet and liquidates your entire account. Yeah, that's how cross works. It draws from your entire wallet for the margin of that trade. And obviously it only uses however much margin it needs for the trade to be open, but the further it comes against you, the more margin it's going to need to keep covering.
And one of the benefits, as we just discussed, is that you're not limited to the stop loss of an isolated leveraged trade.
Right, correct. So if you have isolated leverage and you're at 100x, man, you don't have much room. You got to have your stop really tight, really close, right? Otherwise, you could get liquidated on that trade. So yeah, that's why I use cross. And like I said, it makes me absolutely no difference if I'm trading 10x or 100x. At the end of the day, the numbers add up to the same as far as what I'm willing to risk on the trade.
That's right. Des is asking if you learned from ATP, who's Oliver, or ITC.
I did learn from ICT. Yes, I would say, some of my foundational concepts from ICT, especially with respect to order blocks and whatnot. But a lot of what I'm talking about is just things that I have developed myself as I've grown as a trader, things that I've noticed in Bitcoin's price behavior and things like that. So if you guys don't have any more questions about what we just went through, I'd be willing to pick one of these guys here and give you the rundown on it, but then I probably will have to run.
That sounds great. Yeah. Do you guys have anything that you'd like to take a look at of these four? We got one vote for kill zones.
One vote for kill zones, okay.
2 votes, yeah. It looks like kill zones is the point of interest for this group.
All right, sounds good. I'll do that, and then I'll throw in one of it's very simple to explain, but it's also very, very powerful on the price deviation.
Great.
So kill zones are for me, they're very much for like in the daily range, trading that. So sometimes you might deviate outside of the daily range, but usually by a pretty small margin. For me to be using a kill zone style entry, usually if there is a legit, say, breakout during a kill zone, it's going to be a pretty solid move. Like this guy here, it wanted to break out of the upper part of the range, and I don't consider this a breakout of the entire range. So I would consider this whole thing a greater range, but you have sort of this range and then this range. So in this case, it did travel across the range, but as you can see, it's a pretty good sized move. A lot of the kill zones, of the kill zone action is small intraday weaving back and forth from side to side on the intraday range. So one of the edges that it gives me to know the kill zones well is kind of gives me an idea for forming bias for the next decent sized swing, if you will. Because a lot of times the kill zones set each other up for the price action in the next kill zone. For example, well, this is not necessarily the example here, but see how price trades up, it comes down, and then it sets itself up for this Asia kill zone. Price traded up, and as it goes into the Asia kill zone, it goes down into the kill zone. And that's kind of the characteristic of how you can start to gauge high probability of what price might do, is at least like little small directional shifts within the range, is because it sets itself up for the kill zone. And the other thing that it does, quite frequently actually, is it will take out a high or a low of a previous kill zone. In this case, it was pretty obvious, but I'm sleeping during this time of the night. This is the London kill zone. But whenever price just goes and takes out the previous kill zone high or low, and immediately kind of has a decent little snap off of here, like it kind of means it when it moves out of there, so to speak. Well, to me, that's a good indication that price now wants to go take out liquidity on the top sides of the kill zone of these. See, this is all untapped intraday liquidity, and there's been 3 of them in a row that haven't been taken out. So at this point, when price is at this point right here where it comes out of the London kill zone, the options are we go down here, but all the liquidity's been taken out. It kept taking out liquidity. So either there's a big move down to take out this low, and that would probably result into even a bunch more momentum and maybe go quite a bit deeper, right? The other option is they've protected this liquidity for quite a while. So this is all just up for grabs. To me, this is very, very high probability that we're going to take out all 3 of these at minimum. And, of course, that's what it did. For another example, I actually took this short the other night. The sweet spot for price to shift direction can be sort of at the beginning of the kill zone, like where it just comes into the kill zone and then away we go. And then this is kind of a fuckery zone right here. Like it likes to do crazy shit whenever it gets into the IPTA thing. And sometimes you can, sometimes it will provide you with a really quick entry opportunity like this guy here. This was a fake out. It came into the kill zone when it got into the IPTA time, it just faked like real hard like it was going down, but it was getting ready to go up. So, but for the most part, like I said, this is a fuckery zone and it might not be the best tradable. So the next most popular time for reversals to happen in a kill zone is really kind of in around the middle to, I would say, somewhere right in here. When I saw this happen, first of all, it looked like it was a bit fakey, like a bit of a fake out in my opinion. And then secondly, the timing really lined up perfectly for this to be the turn. And let's see if I go on 5 minute, if I can get a little more detailed. Right. So you've got just like this little 5 minute, I guess you can call it an order block. I don't know if it qualifies or not, but anyway, this was what I was interested in when price got into here, was that this was the inside of the 5 minute on this swing high. So it formed its little top here, and then when we got to the point where it's prime time for market to shift and go to the other side of the range, we get this guy goes up real quick and hunts and takes this out. That was what it was after. It was taking this high out that had previously been set. So when that thing faded, I actually caught the trade about like right in here. It was still in the wick on 5 minute candle on my entry. And yes, after that, it just straight away folded and away it went. So yeah, that's kind of what I use it for, is, finding those potential turns during the middle of the kill zone. And really, most importantly, I guess, would be to just see how things are shaping up throughout the day. Like, what did it do in this kill zone? What did it do in this kill zone? And then, okay, so now I can start to form a bias that if we want to move up, like if tomorrow is an up day, I could see this getting hunted, like the liquidity being taken out here, and then off and away we go the next day. So this is part of what I use for forecasting what I think is going to happen next. Like the next day or throughout the week. Let's see. I'm trying to think of anything else I use kill zone for. Yeah, and another time for a price to shift to is coming out of a kill zone, and this changes week to week. So 1 week, you might start noticing that Asia, the price likes to trade all the way up into the very end of Asia, and then immediately just fold over and come back, do its retracement or whatever. So that might be Asia 1 week, and then next week you'll start noticing that it's doing it on London. And for a while now, I have actually noticed that my trading really starts to improve after about Wednesday. And I think the reason for that is that I start to see the patterns of how the sessions are liking to trade that week. So it gives me a little extra edge. And it also helps for shaping up like the bias of where the week might end up at. It's going to show you price deviation. While I grab that, if anybody has questions on the kill zone, fire away.
Someone's asking if that kill zone indicator is something that, or is that an indicator you can view on TradingView?
Yes. So if you go into indicators and strategies, I have it favorited, but it's this guy right here, ICT kill zones V4. And it's weird because when I clicked on it and it actually comes into my object tree, it's called ICT kill zones V2. All right, you guys want to know one of my best secrets? It's got to do with a price deviation, and I refer to it a lot as a symmetrical swing, which is technically what it is. I use very little fib action. I do use the fib for my deviation targets, for finding equilibrium, halfway points, stuff like that, and then symmetrical swings. So one of the reasons that I was fairly confident that this wasn't going to go much lower is because it created this was the area for the symmetrical swing to be completed. So this was the swing that goes up for this to come down. And a lot of times it goes one full deviation. I know this fib looks a little different because I messed with it, but just so you guys understand, let me grab my other fib. So this is typically what my fib would look like, right? And so if this is what your fib looks like with all the different levels on it, that's what this is, except it has the extensions on it to extend out. And my settings on the extensions are just simply 2, 3, 4, 5. So it gives me the exact deviation of this is going to be the same deviation as what this is. So whenever price breaks out of a structure, out of a range, the first thing I want to know is where is my full symmetrical swing. Now, in the bullish case scenario, that doesn't happen very often. We go much deeper than that. But because the market is so one-sided biased right now, so bullish, the retracements tend to be at the symmetrical swing. Here's your symmetrical swing. And it did overshoot that some, but you gotta understand that was some vicious droppage there, and it's gonna overshoot. It's not gonna be super precise, but in general, that targeted the bottom quite well. Let's look at this guy. There you have it. Again, any question on the symmetrical swing?
Des is asking, is this something that you only do on the 1 hour?
No, not necessarily. I do look on a macro level, or semi-macro, I shouldn't say macro, but on like a weekly level as well. But for this specific market environment, 1 hour, 4 hour, it fits the bill. So this is what it would look like on a 4 hour. Got your last swing up all the way to the top. There's your symmetrical. So yeah, it just depends on what your preference is. If you want to view it on the 1 or if you want to view it on the 4. So you want to be careful not to get involved with the noise here too much. So there's like a little bit of noise up here at the top, and you could conceivably consider this your swing that created the move lower. But I like to take your swing should really be close to the same size as whatever market structure you're in. If your market structure is this or this or this, right? So you don't want to take too small a swing. So like this guy right here, you wouldn't want to take that guy. That's only about half the size of your market structure. And another way to do that would be to just measure it. So this is kind of your average market structure percentage of range. I mean, it's not, this might be a little hard to say that, this is true range. I would say it's the true range of this structure is, again, more like that 7% range. There's a 5, 6. So yeah, you want to be able to measure a swing that fits with the market structure. Make sense?
I think so, yeah.
Cool.
Yep, we're getting some confirmations in the chat.
All right. Well, if I was to share something with you guys in the future, what is there anything specific you guys are curious about or would like to learn more on, or
I would be curious to get some more insight into the other more advanced concepts that you had listed out. I would definitely be interested in hearing about those.
this is probably the most complex one, and also it's quite powerful. It's not as cut and dry as some things. Like you you really need to take things with the right context, I guess, for it to be as effective. But that has really helped me out a lot, because in a lot of cases it saved me from trying to sit in a trade that, the timing isn't right to be in it. So you're sitting for 2 or 3 days waiting for it to break out or whatever it might be, and you end up hopping out because the thing's chopping you up and things like that. So, and also, with the time deviations, this thing is pretty cyclical as far as the expansions go. So with the time deviations, it puts you in the market close to a time where there's a high probability for that expansion to occur. So it makes your probability for a successful trade a lot better, because you're not subject to being trying to take a trade where your probability of an expansion is low, if that makes any sense.
Mm-hmm.
And then price deviations is a lot of just, really keeping track of your range and what some of the favorite measurements are for your algorithm to reach to. I could really get into the whole algorithm thing. I know some people don't really buy into that, and that's okay, but it helped me a lot when I realized that price is delivered on a script, and that there is influence that the algorithm has in the price delivery. Now, I still do think that the bears and the bulls can certainly influence where price goes and so on, but what is staggering is when these drops, and this might not be the most precise example, but how do these percentages get so close, So all of a sudden, let's just say the majority of traders decided they wanted to sell here, and then they waited a while, and then they all decided they want to sell here, and they're all just doing things so precisely that each drop just happens to be 9.5%.
Mm-hmm.
Right? So there is an element to the algorithm for reach. And that's another thing that can up your probabilities, is when you're in tune with the reach, and it does change constantly. So there's a technique to being able to kind of monitor that, but it can up your probability for entries especially in situations where the market is pretty volatile. So if you have a good inkling that the algorithm is reaching about 3 or 4% right now, well, if you look for entries that are in the outer 1% edge of that reach, and get confluence with points of interest or an order block or whatever, it's just another layer of probability to have the trade go your way. Well, with that, guys, I think I'm going to wrap it up. And if you want to send me the video, I will get it on the YouTube channel.
Great. Yeah, I'll send this to you as soon as it finishes uploading.
Cool. And then if you guys have questions, you can always ask me stuff about it in Discord as well. And I'll see if I can't answer any other questions you might have with respect to the content we covered.
Great. Thank you so much. We appreciate this.
You bet. Merry Christmas, and hopefully this will help you go make some extra Bitcoin.
That's right. Talk to you later.
Bye-bye.